Hey, Investing Unscripted listeners. If you want to earn 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/investing unscripted.
Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, sometimes known as Rudolph, joined today by my good friend, Jeff Santoro, the voice of the people. Hey, Jeff.
Hello, my friend. I wasn't going to bring up the red nose thing, but
The tip of my nose is exceedingly red right now. It really, noticeably red.
yeah,
Go
if you're
watch.
a regular audio only podcast listener, it's worth popping into the YouTube for a
Go to
minute just
YouTube.
to see.
Yeah. It's crazy. I have a mild irritation. I'll just leave it at that. Well, I mean, besides Jeff, it's a mild irritation on my nose.
Well done.
Yeah.
Well played.
Yeah. Hey, we've got some good questions, like actual questions from actual listeners to answer. Mailbag time.
It is. It is. It is our September mailbag episode. Before we dive into that, though, Jason, we got a new Apple Podcasts five-star review from Gorsk4023, who had nice things to say about us. So he's a liar. But it's a good opportunity to remind our loyal and happy listeners that if you've not yet taken a moment to give us a 5-star rating and leave a review on Apple Podcasts and give us a 5-star rating on Spotify, we would super appreciate that. We haven't been asking for that in a while, and the rate at which people have done it has slowed, and that is not great for us because the 5-star reviews really help people find and enjoy the podcast. Any help in that department would be appreciated.
In all seriousness, of course, Jeff cannot take a compliment. Thank you for the kind things that you said about us there, Gorsk. Really appreciate it. It's good to know, and it helps. I want to say this too about the reviews. Number one, give us feedback if there are things that you like that you think we could do better too. As long as it's a 5-star, then we
Right, we
will
only
read
listen to the feedback if it's accompanied by a 5-star rating.
Right. But I will tell you, it is like this particular one. It had been a while since we get ratings pretty regularly, but with the reviews, the written reviews, we don't get as often lately. That's great. That's great feedback for us because, we don't have a live audience watching us, giving us that feedback. So it helps us. It helps energize us too. Thank you for that.
And the last thing I'll say about it is, we do have friends who do other podcasts, and some of them have been on this show with us, and we want to have a better rating than them, if we're being completely honest.
That's entirely why we want your reviews.
Right.
We
So
want
if
to
you
be
wanna-
higher than Chit Chat stocks.
Yeah, if you're competitive, like we are, and you want us to have a higher rating than our friends, help us out.
Yeah. Yeah.
All right, let's dive in here. We got a bunch of good questions this month, and as a reminder, if you're listening to this, you can send us questions at any time via any means. We have a pretty good system in place of keeping track of everything so that it won't get left behind. You could leave us a question today, and we'll just hold on to it, answer it at the next mailbag. So whenever you have one, send it along. So the first one, Jason, comes from Dan via email. And Dan says, are you guys considering moving any of your money from high yield savings to somewhere that has a high rate like a CD? I am considering putting half of my cash, I have more than 12 months worth of expenses saved, so I'll be fine, into a CD to make the most as I can for as long as I can. And I think Dan's referencing the fact that it's widely expected that we're going to get some interest rate cuts. In fact, by the time you listen to this, we probably have already gotten an interest rate cut because we are recording this after the market close on September 17th. So tomorrow, I believe, is the day. The 18th.
Yeah, today was the first day of the Fed's meeting, 2-day meeting. So we're going to hear a lot more tomorrow afternoon. So
this question was fortuitous timing for me because you and I had been talking about this on the side. I had actually been considering doing this exact same thing. I have a bunch of money I'm earmarking for my son's college. It's just sitting in cash in a high yield savings account. And I actually had the same thought, like, should I lock into a CD now while rates are still where they are, knowing that as soon as the Fed Yeah, I've noticed this. When the Fed was raising rates, it would take several weeks for my high yield savings account to raise
Yeah.
its
Yeah.
rate, and I'm assuming if we get a rate cut, it will not take them as long to
Yeah,
lower
I can't
the
remember I
amount.
can't remember if it was the Wealth of Common Sense blog or if it's somewhere else that I read that was talking about it, but, like, the evidence is pretty clear that rate cuts happen about twice as quickly as rate hikes increase the yields that banks pay to depositors. So, I think you're right. It will certainly happen
Yeah.
faster.
It's like when you owe taxes, they cash that check within, like, minutes, and then when they have to pay you taxes, it takes 3 months for them to wire you the money.
Yeah, no, that's exactly right. No, this is it's interesting because I think this question is, yeah, I mean, it kind of rings for me in a beyond just the conversation that you and I've had about thinking about doing kind of this exact same thing, but the podcast episode that we released, I guess it'll be a couple weeks ago when this comes out, with the personal financial decision that we've made, my family's made, to start shifting more of our invested assets into bonds, right? Bond funds and also bonds. And one of the things that I chose to do as I started going through my research was invest in and look on your depending on who your brokerage is, you may have access to CDs at lots of banks. You don't always buy CDs directly from the banks. So Fidelity is the brokerage that I use, for example. In their like fixed income, where you'd find bonds and kind of doing all of that, the research, they have CDs as well. And there were 5-year and 10-year CDs yielding 4.5 and 4.55%. Now they're callable, which means that the bank at some point may actually choose to call them in before they expire or before they mature.
Because
But
even though you're doing it through Fidelity, you're actually buying it from some random small bank
yeah, no,
in.
yeah, exactly. I'll have a CD deposited at that bank. And they're small banks. And one of the reasons they do something like this is because they're small and they're trying to raise a lot of capital, better access to capital markets for them. It's one of the reasons they do higher rates as well, because it's more attractive and they can raise that capital. Of course, it's still a CD, so it's still a deposit at a bank, so it still qualifies for FDIC insurance up to the deposit limits per person at that institution, right? So that's kind of a cool thing you can do. And for me, it's like, these are pretty good yields. Now, it's not like a bond where the bond value goes up if interest rates come down. It's a CD, so it's deposited and it's just worth whatever the money's worth. But yeah, I think it's a perfectly reasonable strategy to take to shop around right now for CDs.
Well, and I agree, and it's something that I'm pretty sure I am going to end up doing. But what's interesting is just today, you and I were chatting about it, and you gave me something different to think about. So I'm going to really quickly put some numbers around this, because looking at the bank where I have my high yield savings account, it's currently yielding 4.4%. The 6, 9, and 12-month CDs that they offer are higher, 4.6, 4.7, 4.6. But everything longer than that is lower. Not
Yeah.
a ton lower, 4.1, 3.9, things like that, the further you go out, which is we're still in this weird place where longer dated
Yeah.
CDs are lower interest rate than shorter dated ones.
Historically, that's not how it has worked.
Right. But we're still in that world
Yeah.
right now.
Well, because we know rates are going to come down, right?
Right.
How much is in question.
So I was thinking of taking the money and splitting it into thirds and doing a 6-month, a 9-month, and a 12-month. So starting in 6 months from now, I would get a slug of it back every 3 months, right? Just to have a little bit more liquidity. And you pointed out that it might be smarter to take the lower yield and roll
Lower
out
longer.
lower longer, right? Take the
Yeah.
3 point something or the 4.1 or whatever it is and do 3 years, because I don't really need this money till then. Because your prediction is that 12, 18 months from now, you won't see anything above 4% or 3%. So that I don't have an answer to that. That's a
Yeah.
decision I need to make, and along with my wife, to figure out like what we're comfortable with. But that is
Yep.
something for Dan to consider. I'm not going to give advice. You have to consider like the shorter term, higher.
I don't think it's advice to give it. I think,
No, I was about to say like you
Yeah.
have to think about, but I think
no,
you
I
do
think
have
you
to think about
should.
it.
I mean, that's not,
Yeah.
you're not telling them what to do by saying you should think
Right,
about
right.
this. I think
Yeah.
that's reasonable. And here's the point. This is what I wanted to say is why are you saving the cash? Why? And by why, I mean, it's not philosophically why, but what is the purpose of that cash?
Right.
And when is the purpose of that cash? Something else that I read recently talking about how, there's so many people that have turned into savers because for the first time in a generation, you're actually getting a yield, right? You're actually being rewarded for saving cash. And well, that dynamic is going to change some. We're not going back to what it was like in 2013 through really 2022, right?
Yeah,
We're
we're
not
not
going
going to
back
see
to
1%
that.
interest rates. Yeah.
Yeah, we're not going back to that. But the days of getting 4.5% in savings and getting 5% in a money market, that is going to go away, and it could easily drop over the next year to 3% or less. I mean, I think there's
Right.
a realistic case that happens, and if it does, and all of a sudden you're getting that much less of a return for cash that you're planning on holding indefinitely, that's not good financial planning, I
Well,
guess is what I'm getting at.
here's the other thing I would say Dan should think about, right? So he said in his question, kind of parenthetically,
And if your name
I
is not Dan, you can think about this too.
right. This is for anyone, but Dan did ask the question. But he said
Yeah, yeah.
parenthetically in his question, I have more than 12 months worth of expenses saved, so I'd be fine. I think he's referring to like he doesn't need this money in the short term. Now, again, not financial advice, but 12 months of expenses is a big emergency fund by what I think most people would consider to be the amount you'd want to hold on to. So I guess my question for him to think about would be if you have 12 months worth of expenses in cash already, and this is cash beyond that, are even CDs the best place for that cash?
Yeah.
Depending on your age, I don't know anything
Yep.
about Dan, depending on his age, his family life, how many years he
Income,
has until
career,
retirement.
do you own a home,
Right.
dependents, all of that
Like maybe
stuff.
the right place for that is in stocks or in some other asset, right? So
Yeah.
that's just another thing to
Or
think
even
about.
longer dated CDs.
Yeah.
Yeah. Or bond funds.
Nobody
Or
wants
even,
bonds.
yeah, Dan, you might even want to buy some bonds, buddy.
Right, great. Now the
Not even,
whole audience just fell asleep because you said bonds. All right. We did have some fun Twitter banter about other Bond fans. So there's two things that I like to joke always put me to sleep. One is bonds and the other is soccer. I just angered all the soccer fans out there.
Hey, everybody, we'll be right back, but first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company specific segment and KPI data on around 1,800 stocks. So, for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com. Okay, let's move on. We got another question here from frequent writer to the show, Colin, who sent us this question via Twitter. Do buybacks fuel future dividend growth? As a predominantly dividend growth investor, I love seeing a big dividend raise. My future income goes up, and it shows management has some confidence in the way things are heading. I get less enthused when companies opt to buy back stock over a larger dividend raise. But does buying stock fuel more larger raises?
The company eats up shares, so it's paying less dividends out to shareholders, leaving less of an impact on the cash flow and the balance sheet to cover the dividend. Is my thinking right? Doesn't buying back undervalued stock juice dividend raises in the future? There's a second part to his question about a book to read, but let's get back to that part later. What do you think about Colin's question?
So a couple things that Colin put in here, and I love that Colin really kind of answered the question in a way. But there's the questions he start with and then the question that he finished with. They sound alike, but they're different. Do buybacks fuel future dividend growth? The answer is sort of. His last question, doesn't buying back undervalued stock juice dividend raises into the futures? Absolutely, yes. The key is just like anything else a management team does with capital, you got to get a good return on the capital, right? You need to allocate the capital well. And one of my biggest frustrations as an investor over time is that you see the wave of stock buybacks crests with record profits and record stock prices. And then the wave of earnings comes down, economic reasons or cyclical reasons or whatever. The stock price comes down. And what does the company do? Halts buybacks. It's a massive frustration. And a lot of times we see companies tout buying back stock, big buyback programs, when all they're doing basically is just they're erasing liquidity, right? Or dilution from stock-based compensation. They're not actually increasing per share equity.
Or if they are, it's at a much slower pace because so much of what they're doing is being eaten up by stock-based compensation.
Right. I mean, that's exactly it. And that's why when we talk about stock-based compensation, a lot of times we say, look, yes, it's not a cash expense today, and that's great for a growth company, but it's a future cash expense because at some point, ideally, companies get big, they get really profitable. Their profits have gotten so much bigger than their stock-based compensation that they have enough money to start buying stock back. And the goal is to reduce the share count, right? To create that value. And it comes down to value. And the good management teams are the ones that are smart about buying back shares when their shares are cheaper. And when they do increase the dividend, they do it when they know it's sustainable, right? Because this is a difference between American companies and a lot of companies in Europe that pay dividends. Is the dividend here is like a promise. It's like, okay, you're going to get it next quarter too. We're going to keep raising it. We raise it. We're going to raise it next year too. And we'll definitely raise it the next 25 years after that. I promise you. And the problem is you end up with a 3M or a Walgreens where 30 or 40, 50 years later, there's been so much focus on growing that payout and chasing ways to grow the business. You can no longer do it, right? And you've lost focus on actually creating value for shareholders. And the other end is you get these very rare exceptions like NVR is one that's done an incredible job with buybacks. They don't do the dividends, but they've done a really good job with buybacks. And probably my favorite buyback and dividend growth stock over the past nearly quarter century, call it 22 or 23 years now, is Texas Instruments. They've bought, I don't know, half their stock, 70% of their stock back. It's this massive amount of stock that they've repurchased while also growing their dividend at the same time. Because the core focus for the business has been growing free cash flow per share, right? Doing things to the business to allow the business to grow free cash flow per share.
And buying back stock is a way to do that.
It is a way, right? Yeah. That's the key. It is a way to do that. And then you have companies like 3M and others that have acquired other things. They've tried to get bigger by buying other stuff. And it doesn't work. Sometimes it works. And there are companies that are really good at like doing roll-ups, where they're good at buying these bolt-on things that fit and they can make the whole business bigger, and they're really disciplined about it, and they pay really good prices when they buy stuff, and they know how to integrate them into their core operations really well and trim the fat and grow cash flow per share that way. Usually the companies that are really good at doing that kind of stuff do buybacks really good because their management knows how to allocate capital. I think generally for most companies, like your average company that it's just a really good business and maybe they don't have it's not a business model built on capital allocation. As long as they're regularly buying back stock, they're dollar cost averaging into their own stock, for lack of a better way to think about it, generally it's going to create value for shareholders.
Yeah, you went into detail on kind of how I would have answered this, which is I think a lot about the whole dividend versus buyback thing, and I always come down to it depends, which is kind of what you're saying, right? It depends on how good the management team is on allocating capital, how good they are at buybacks.
Yeah.
Because like you said, a lot of times they're doing it solely to offset dilution. A lot of times they do it at the exact wrong time. The other thing too is just because a company announces a buyback doesn't necessarily mean they're going to buy back.
Right.
And it's
They'll say that
important.
the board has approved $2 billion in
Right.
share repurchases.
And I do
They're
think
not doing it tomorrow.
well, they could.
Right.
That's the whole
And that
thing.
they could, but that's it's just an option to do it.
And that's where I like when companies straight up tell you we bought back this much stock at this average price.
Yeah.
I really like that because that tells you like if they're telling you the price, they're proud of the price they paid is the way I think about it. If they know they overpaid, they're probably not going to say that part. And then so I think that's you have to take all those things in consideration when you weigh that against getting the dividend instead. Both able to be cut, right? Like you can cut a dividend, you can stop buying back stock. It does feel like the dividends are a little bit more permanent or so to speak because there's the PR hit of lowering your if you cut or suspend your dividend, your stock's going to take a hit. It's going to be a news story. If you don't buy back stock in any given quarter, it's barely noticed. So from that standpoint, I lean towards dividends, but yeah, it just depends on the company, the management team and how they handle it.
One little last bit here. There's one thing that I do look at companies that have a long track record of growing their dividend. I also like to look at how has their balance sheet changed over time? Because what you find in a lot of cases, companies that grew their dividend a ton also added a ton of debt. So money's fungible, right? So you can do two things at one time. So like a lot of these companies, like, okay, they're acquiring assets that are going to generate cash flow. So like I'll use Brookfield Infrastructure as an example. They've acquired billions and billions of dollars worth of power transmission lines and data centers and natural gas infrastructure and like all of that kind of stuff that's their core business. And they've also raised their dividend like 7 or 8% a year on average over the past roughly 15 years. So you can say that in part, because they've also raised a ton of debt along that way, in part, they funded their ability to grow the dividend by taking on debt, right?
Yeah.
Because there's an alternate world where they took on less debt, didn't pay as much of a dividend and didn't grow their dividend as much. And the business would have less leverage, less debt to service today, more cash flows, but it would be paying a much smaller dividend. So there's a balancing act there, right? It's not just this pure one thing or the other.
Yeah. And one other thing that I thought of is, and this is not exactly what Colin was asking about, but it's related to dividends. And I think it's worth exploring. Paying a dividend is different than issuing a buyback in the sense that it puts the onus on us as the dividend receivers to then be careful how we allocate capital. Because if you don't have dividend reinvestment automatically turned on in your brokerage and you're just taking that dividend as cash, now you're the capital allocator.
Right. You're
Right?
on the hook.
You're taking that Brookfield, Walgreens, 3M dividend and deciding how to spend it. So that it's a reason I don't do any dividend reinvestments anymore. I take it all in cash because I'd rather use that toward whatever I think my best idea is the next time I go buy a stock. But if you're taking in significant income via dividends and you're not reinvesting, or even if you are reinvesting it automatically, that's you making a capital allocation decision for your portfolio too. So I think that's just another kind of twist to the whole dividend versus buybacks debate. The second part of Colin's question is this. Have you read the book Die with Zero? If not, it's about a 4-hour read. It kind of blew my mind as a father and someone who enjoys investing. It's changed my mindset. I would think it would make a good show if you guys read it and reviewed your thoughts on the author's take.
Yeah. So Bill Perkins is the writer. Bill Perkins made a ton of money as an energy trader, a younger guy too. I think he's still in his early 50s. And there's some videos out there where he talks about the book and almost the frameworks. And like some of the things I like about the idea of this book, I haven't read it. I bought it. It's coming, but I haven't read it yet. Is he talks a lot about how your money, you earn money by you trade your time for money, right? Obviously, one of our goals as investors is to turn our money into more money so we get more time back. But one of the things he talks about is philosophically, you have to align your values with your money, right? When you think about getting as much of your life back as you can to do the things that you want to do, when do you want to do it? And the whole goal of Die with Zero, the story, is to maximize your life when you can maximize it. Like one of the videos that I watched, he says, there's 2 times in life that you really have no direct need for money, and it's when you're a baby and when you're on your deathbed. So the hard part is figuring out all of the time in between how to spend your money with intent based on your values. So I'm excited about reading it, but I'll weigh back in after I read it. I'll report back.
All right. Future episode there, Jason will give his book review. Hey, everybody. We'll be right back. But first, a word from our sponsors. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part? If you act now, you can potentially lock in a 6.9% yield until 2028. The new bond account, only at public.com/investing unscripted.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit chat about investing every single week. From hot stocks such as Nvidia and Celsius to hidden small cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts and start discovering new investments today.
All right, let's move on to our next mailbag question. This came from Seth via email. Seth says, I enjoy the show. Thank you guys for all the information. I'm curious if you guys ever invest in any commodity or materials companies outside renewables. How do you approach them if so? I ask because I noticed OXY, which is Occidental Petroleum, is near 52-week lows, and with Buffett's growing stake, it looks interesting. Love to hear your guys' thoughts. So this is an industry and a part of the investing world I do not dabble in at all, Jason. So this is all you.
Yeah. So I cut my teeth as an investor and as a researcher and writer covering the energy industry, a lot of oil and gas, also covering steel to some degree. A couple things with Oxy stock. It's down a little bit, but it's down a ton over the past decade, right? Sometimes it's easy to forget that the stock is still way down over the past decade. The buying opportunity, as far as I'm concerned, was when Buffett was loading up on shares after they had backed themselves into a corner with the Anadarko Petroleum deal, which was a big overpay, and they didn't have the money. Uncle Warren had the money. He got a sweetheart deal with some warrants. They've increased their stake since then. So, I mean, Oxy's fine. I know you're not asking specifically about Oxy, but I think what you have to think about with different companies in different parts of these commodities industries is you need to understand how they're exposed to the commodity. How do they make a living? How do commodity price cycles affect them? And then think long-term, what are you looking to attain? So like Occidental Petroleum or Devon Energy or, in any of those oil and gas producers, they live and die on oil and gas prices. They go look for oil and gas in the ground or under the ocean, depending on the business. They have contractors that drill for it, produce it, and then they sell it. And they generally sell a portion of it under contract. So they have a certain amount of pricing. It's locked in. So it kind of gives them a floor, right? And that entire industry's got a lot better about their cost structure. But at the end of the day, especially in the short term, their stock prices are like leverage bets on oil and gas prices. They move in lockstep, right? So that's just kind of one of the realities of those sorts of businesses. You can look at, and Tyler Crow and I've made a number of videos over on our YouTube channel with one of our partnerships. And we've done a lot of videos looking at some of the lithium companies. And it's the same thing. Lithium prices have absolutely crashed. And you go back to like the EV stocks startup a few years ago, like that big bubble where everybody was looking for the next Tesla. And all of those stocks are down 80 or 90%. Massive amount of money, like billions of dollars went into developing more lithium. Growth has slowed a ton in demand there, even though it's going to continue to grow. But there's this massive amount of oversupply that's been overhanging that whole market. So generally, as a retail investor, if you don't already follow a commodity closely, you're hearing about it. If you're investing, you're somebody's bag holder, right? You're too late. You're just too late. You have to know the cycle.
Right. Like if lithium is on your radar because everyone's talking about it, that's the wrong time to be buying lithium.
Right. Yeah. No, it's generally true. It really, really is. But then there are other companies that are like more value additives where you can do well. It's like in the oil and gas business, Phillips 66. They're a refiner petrochemicals manufacturer and they have all these pipelines and like the infrastructure, they're far less exposed to commodity prices than than the producers are, or a miner would be in something like lithium or steel or iron, I should say, steel producers. And they've been able to create more value over the long term because of their business model, and also share buybacks, by the way. We can throw that one out there too. And also dividend growth. Colin, we'll tip the hat to you there. So there are companies that are in those commodities industries where there's opportunity. Generally, as a retail investor, the best time to invest in them is when nobody's talking about them, when absolutely nobody's talking about them, because the stocks are depressed. Nobody's searching for them, so nobody's chasing the Google SEO by putting lithium stocks in the headline or whatever. Generally, that's the best time to buy because it's at the bottom of the cycle. The stock prices are depressed. And over a multi-year horizon as the cycle turns, if you buy good quality companies, you can do pretty well. It's just really hard long-term to own those businesses and expect great returns.
Yeah, I won't say too much because I've already expressed the fact that this is not an area of investing I'm comfortable with, but it's always felt like a lot of work for not a lot of returns to understand these kinds of companies. And I'm sure there are plenty of examples where there have been great returns, but if I'm going to put hours of work and thinking into something, I'm going to pick something a little more exciting than lithium stocks, but that's just me. Okay. Next mailbag item is from Andrew via email. Andrew says, love the pod as always. One of the big changes I implemented in the past year has been setting up a spreadsheet triggers to advise me when to buy. So if the market drops 5%, I take my cash levels down to 12% of my portfolio. If the market drops 10%, I take my cash down to 10%, and so on. I've debated internally about these percentages, but hopefully over time, I'm putting more money to work at opportune times. The problem with this plan is boredom. My plan is increasingly telling me to wait and do nothing right now. What is your best prescription for investing boredom? So I know you have thoughts on this because you have a pretty, I don't want to say strict rule about when to use cash, but you have a process. But I want to chime in first on this one. This really resonated with me because there's a part of my logical brain that says I should probably not buy every single time the money hits my account and let it build up a little bit. Not even so much for a massive downturn, like a 2022, 18-month long bear market, but even just for those random 5-day spans where sometimes the market will drop 5 or 6% just over the course of a normal year, so that I have the cash to buy in opportune times, like Andrew says. And I just cannot bring myself to do it because I like buying stocks too much. Yeah, that's one of those things where my logical brain argues with my, I don't know, whatever the non-logical part of your brain is. But I guess the way I would answer this, if I were trying to come up with a system, which it sounds like Andrew is like a systems thinker when it comes to this stuff. If I'm just going to pick random numbers here to make them easy. If you're able to invest $200 a month, like that's what you're able to spare, maybe take half of that, 75% of that, 40% of that, and buy regularly with it and squirrel the rest away. So you're still sort of scratching the itch of not being bored, but taking money and keeping it for when the market drops, and then you can go hog wild. So that would be the way I would do it if I were to come up with some sort of system, but you have much more well thought out plans as it pertains to this. So I want to hear what you think.
So there's a few things we don't know. As a starting point, we don't know what is the steady state cash percentage. So
Well, since he says he takes it to 12 if the S&P drops, I'm guessing he has more than 12% in cash normally. That's how I interpreted this.
I don't. This almost to me feels like, and again, we're making some assumptions here, but
Yeah.
it almost feels like when we see a 5% drop, Andrew says, okay, I need to sell a little. I need to free up some cash on this little decline because it's an indicator that there's a bigger decline coming.
But then the next sentence says, if the market drops 10%, I take my cash levels down to 10%.
Right, which means that you will be buying.
Right. So I'm assuming and he says buying at opportune time. So my assumption is when the market drops,
so again, we have incomplete information.
Yes.
Which is always the case, right? That's whenever any question we're answering, we have incomplete
Andrew could
information.
be 22 or 82.
Well, but the other thing too is like, but I think this is important because we also have incomplete information when we're acting for ourselves. Let's be honest, right? When we're making a decision to buy a stock, to sell a stock, we're always right trying to work in an imperfect world with imperfect information to try to find a perfect solution. So I think one of the things I want to say here is that this is definitely the kind of case where, directionally, I love this idea because sometimes you just need something good enough to keep you from having unforced errors, right? I think that's really important. All right, but again, directionally, I like the idea of having some sort of a process. So my process, which has evolved, I've increased the amount of cash that I carry from a goal of around 5% to 10. Like 10% is how much cash I tend to like to carry. If I see a 5% market drop, I start to get interested, but I don't really actively start looking to deploy that. And again, that 10% is above and beyond my regular contributions. I'm a net contributor. I'm in my late 40s, peak earnings period that I'm kind of entering into. So this is the point in life where I'm putting the most amount of money in. So I have that 10% in cash and then the regular contributions that I make. That's my regular buying. And sometimes I go through periods where I might not deploy as much. It might be a few months and then I might really start to buy more. But with that 10% in cash, I'm generally only acting when there's clear opportunity. That 10% market decline is like, that's the first trigger for me where I'm going to take probably close to half that cash and go to work because there's a good chance if the market's down 10%, there are some things that I'm going to be really interested in buying. They're going to be down a lot more than 10%.
Right.
And then we start seeing like 20% level declines. That's when I'm going to run out of cash because I'm going to get pretty aggressive over multiple months, not multiple days, when we see that sort of a decline. So I think a process is good. I would say, and again, Andrew, there's so much we don't know, but beware trying to be too perfect and precise with it and think about the percentage of cash you're getting, the purpose of that cash, short-term, long-term, what kind of return are you getting for it? Are you sacrificing return for some sort of optionality that doesn't make sense to try to be solving for? So that's the one thing that I would think about. The boredom part, listen to more podcasts. Get a job driving an Uber. Like
I know. I mean, I know you're being funny.
No.
But the investing boredom is a real thing. Like I
it
feel
is.
that.
No, it's true. It's true.
Yeah.
Honestly, though, one thing you've talked about: trade less, learn more. When you're getting bored, idle hands are the devil's playthings, as they say. You have to inoculate that by doing things that are going to make you a better investor. And acting in a time that you should be inactive is probably not the best thing to do. Go research the companies you own.
Yeah. One thing I'd love to get better at is getting to a point where I know the price I want to pay. And I mean price, not so much the dollar amount, unless I'm correlating that to the valuation metric, but like knowing the price I want to pay for a company I have high conviction in.
Yeah.
Right. So just to pick a company we've already talked about today, let's just say I had really high conviction in Brookfield Infrastructure. And I want to get to a point where I know enough about valuation to say to myself, okay, if Brookfield trades for X percent or X times free cash flow again, that's when I'm going to deploy some of my cash hoard and buy like a half a position or a full position, whatever I decide, right? Because then you're being a little bit more micro opportunistic and less macro opportunistic. Because the other thing that I was thinking about as you were answering just a second ago is I remember whenever it was the beginning of August, we had those 2 days where the market dropped a lot and I didn't do anything. I waited. And then of course, 3 days later, the market had rebounded and everything was back up. But the reason I didn't do anything is I went through the stocks I already owned and even some of the ones I have on my watch list. And even though some of them were down 9% over those couple of days, that had only really put them back to where they were in like mid-July.
Yeah.
And I thought to myself, well, this isn't like a generational opportunity. I'll just be patient. But had I done enough work in advance to say to myself, okay, when this company drops to this price or to this multiple, I'm going to buy it. Maybe I would have done something that one of those days and it would have been a smart move. So to your whole like learning point, like maybe that's the next step.
Well, a couple things. I'm glad you brought up that kind of that mini little sell-off that we had and how quickly the market rebounded. There's a lot of people that are kicking themselves for not acting quickly. I will tell you, generally, not acting quickly with a little sell-off like that is the right move. Most of the time, it's the right move. So it's definitely a case of process over outcome, where historically you get a sell-off like that and all of the concerns that were there are still basically there. Stock valuations are still pretty elevated. Like all of that stuff hasn't really changed. Coming to the right conclusion about those things, I think, is really important. And the one last thing I wanted to say about thinking about valuation is there's two different buckets when I think about valuation, about when to act and when not to act. And that's when it comes to these really high growth businesses where paying the perfect price is only in hindsight going to have been a perfect price if the business really executed well. If the business doesn't execute it, it doesn't really matter what you paid, right? The returns are driven more by the business. And then there's the more of it's a steady, stable business that's growing at a much slower rate where the price you pay matters a lot. And that's a case where you need to be more precise about valuation. Whereas in the former case, the high growth sort of things, you want to just be directionally within the realm of what you want to pay, right? Not being too disciplined about the price when you know you want to own the business and be happy with close enough. But if it's, say, a Starbucks, you may want to be more disciplined, right? Because the growth rates are slower and the difference in 5% of the stock price can mean can half your returns over a 5-year period.
Yeah, for sure. All right. So that's almost the end of our mailbag, Jason.
Yeah.
But I've saved the best for last.
Absolutely.
It is time for the spam question of the month. So we get tons of spam, mostly on our Twitter account. Thanks, Elon. So we have resolved, starting last month, we resolved that we would always answer one spam question. So this one's for you, Jason. This came from a person on Twitter with a very attractive photo. I'm sure it's a real person. And the
of course.
Yeah. And here's the question. Hi, I hope you are doing good. I am from UK. May I know where you from?
Yeah. So our social media intern actually replied to this DM, and I thought it was great.
Our social media intern's response was very funny.
It was fantastic. I am a podcast. I am from the future. It's very good.
And I noticed there was no reply. So I guess that's not the answer that this avid listener was looking for.
I think we blew them away.
Yeah.
So good job by our intern there. Where am I from? I am from a place long, long ago and far, far away. What about you? Do you have an answer?
Oh, I'm from the future for sure. Yeah.
No, you're not. You're from New Jersey. Come on.
New Jersey is the future.
It's the end.
You should come here. I think you would like it. I think you would enjoy New Jersey.
Oh, the best two parts. Getting there and leaving.
No. I mean, look, let's compare it to where you grew up. We have plumbing, indoor plumbing.
Well, so I was going to say we have plumbing.
We have consistent electricity.
Then you clarified, and it's like, okay, I got nothing now.
We have consistent electricity. Most of us have our teeth, except for North Jersey. You get up to like Sussex County, and yeah,
you're doing a good job just making everybody mad at you, Jeff. I am here for it. I'm here for it.
We've bantered enough.
Yeah, we've gone far enough. This is great. Hope you guys enjoy the nice short episode here. Thanks for the questions. Gonna ask again. Continue sending them in. This asynchronous communication is wonderful. You don't have to wait for the call out. When you get the question, send it to us. So reminder, if you're listening to us on Spotify, you can actually send us your questions on there at the end of the episode. Where is it, Jeff? I don't use Spotify.
There's always a question prompt, but it's usually just generic. But usually on the mailbags, I make it say, do you have any questions for the mailbag? So you can click on that after any episode and ask us a question or tell us how we're doing. And actually now Spotify lets us reply. So I can give you a little heart and say, thanks for listening.
Yeah. We won't answer it. We'll answer you on the podcast.
Click the button.
Next month. There we go. Okay, Jeff, that's it. I think we've said it all.
We said it all.
Said it all for September, for a podcast episode. This is not the last episode of September, unless it is. All right, friends. As always, we love to give our answers to these hard investing questions, whether they're questions we come up with or questions that you get to us. But our answers are just a starting point. It's up to you to find the end point and to answer those questions for yourself. You know what? You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.